Welcome to the Mayor of Money podcast with former Burlington Mayor Rick Goldring of Goldring Financial Leadership. In this podcast, we provide successful business owners, including doctors and dentists, with insights to minimize tax and risk while maximizing retirement income and future legacy. Join us for this journey as Rick draws from years of experience and guest experts, including successful entrepreneurs, to provide unique strategies and approaches to estate and financial planning matters, as well as business in general. Now, on to the show.
So my guest today on the Mayor of Money podcast is Mike Heddle, who is one of Canada's leading real estate brokers. He is ranked amongst the top 1% of agents for Royal LePage out of 19,000, and just in March of 2022 was named the A.E. LePage Realtor of the Year for Ontario, which is a very prestigious award recognizing the best of Royal LePage realtors based on productivity, leadership, and brand engagement. And he has been featured in numerous media outlets, including CBC, CHCH News, CHML 900, other podcasts, including the Mayor of Money now, and certainly a number of magazines. And he routinely speaks to some of the country's largest investment networks on teaching Main Street investors how to create and build wealth through investing in real estate. So Mike, welcome to the Mayor of Money podcast.
That's awesome. Thank you, Rick. Thanks for having me.
So how long have you been in the real estate business? When did you get started? What was the impetus for you to go down this path?
Yeah, I grew up in an environment and a family of medicine. My grandfather was a GP, and my father was a surgeon, and my mother's involved in transfusion medicine. And I was surrounded by the medical community, and I was encouraged not to follow their path, not to get into medicine. And I'll never forget my father saying to me, you're going to work weekends and evenings and take call, and you don't make the money up here in Canada that they make down south of the border. So I was encouraged not to follow their footsteps, and here I find myself in an industry or a career where I'm working evenings and weekends and taking calls. So I listened to some of his advice, but not all of it. As I was finishing university, actually, I had some interest in investment. I studied economics and commerce. I like numbers and number crunching. I have a background in economics. We spent some time down in the Cayman Islands and Panama looking at some offshore banking opportunities. And I came back and I thought I wanted to become, I was young, I was 21. I thought I wanted to become an international real estate developer, whatever that may be. I registered for the Ontario Real Estate Association courses. I knew nothing about real estate, and started doing my first phases as I was finishing university at McMaster. So it really started more out of curiosity. That was back in a day and time where we didn't have all of this HGTV and reality TV shows. So it was more just kind of curiosity. I'd heard that real estate was a great investment, and I was always attracted to investing and finance. So that kind of started my career, and I started selling. I got licensed shortly thereafter and loved the process of selling and advising. Here almost 20 years later, I find myself still in the business. I'm not an international real estate developer. I'm a trading active real estate broker here in the Hamilton, Burlington, Dundas, Ancaster region.
Now you specialize in working with Main Street investors. That's sort of your terminology of some of the people that you serve. When did you decide to focus on working with the investors as opposed to the traditional market in real estate?
Yeah, I think some of my background lended to the interest in analyzing kind of the performance and financial aspect of real estate. And when people think of real estate, most people think of shelter, providing a roof over my home and or over my head. I found it very interesting, why this asset seemed to appreciate and not depreciate like a vehicle or any other kind of declining asset. So I started actually early in my career. I had clients that were coming into Hamilton through the Faculty of Medicine, and often didn't have anywhere to stay in a short term. So I started buying rental properties. I had a couple of properties that I would fully furnish and rent out in a version of what's now known as Airbnb. And I did this again back before there was such technology such as Kijiji or Craigslist, and back before the internet era really took off. So that's what started it for me. Is I would fully furnish a suite. I would have a physician come in, pay good rent, and sometimes they were there for a week, or sometimes they were there for 3 weeks, and the cash flow was just fantastic based on my carrying cost. And so really the interest started from being a practitioner, having a couple of rental properties that I found a small niche in the fully furnished space. And then we started working with clients that wanted to do the same. And again, about a decade later, started working with one of the country's largest investment networks on advising investors how to, acquire and what to look for when looking for revenue generating real estate.
So here we are in 2022, the real estate market in Canada, the residential market, almost everything in real estate has gone up astronomical in the last couple years. And here we are, there's still people that want to continue to invest in real estate that you would call Main Street investors. There's people that want to maybe start to become a real estate investor. Has the market changed that it makes it more difficult and more challenging to invest in real estate today than it did 3 or 4 years ago?
It certainly has. I've been doing this for almost, as I mentioned, 20 years, and I've seen prices continue to appreciate. One of the mistakes I made over a decade ago was selling a couple of my rental properties when I see where values land today. I'll kind of preface this by saying we take a consultant's approach. So most real estate salespeople, in fact, that's why I got rid of my salesperson license and I have a broker's license, is I'd rather give a consultant's approach, when investing in kind of any asset class. I've been a lifetime investor, but specifically real estate. Often we teach some of our clients or our investors to look at the fundamentals of how income properties generate revenue or wealth, and there's 4 fundamentals that we would often look at. The first would be, if I were to buy a property and put in a tenant, I should be generating positive cash flow, and we would look at that first kind of revenue stream as cash flow. The second would be principal.
So just defining that, Mike, that is the revenue that's generated after you've paid all your costs from the rent when you have an investment property.
Yeah, that's right. I don't want to dive too deeply into kind of a financial pro forma, but most people, when they think of investing in real estate, when I tie that into the 4 fundamentals, and I don't think you should speculate in real estate, meaning prices are going to continue to go up. I would boil it down to first principles, meaning if we find a tenant or tenants, 2 or 3 tenants, if it's a duplex or triplex, will their rent cover all of our expenses? And our expenses might be something like carrying a mortgage, property taxes, vacancy, so on and so forth. So that first column that I talked about there is the 4 fundamentals would be cash flow. We want to make sure that rent roll, or the money we bring in from rent, covers all of our expenses. And if it does cover them all, it would give us a positive cash flow, which would generate that first line item as positive cash flow. So that's the first way to win when purchasing or acquiring real estate. The second would be, in that same kind of concept, we've got a tenant that's paying down our mortgage. I talked about, part of our carrying cost would be mortgage. And we all know that our mortgage consists of 2 components, the first being principal and the second being interest. So as a tenant is in the building paying rent, it's almost like a forced savings. They're paying down a portion of your interest, a portion of your principal. And we can calculate that principal on an annual basis, and we can convert it into a rate of return on our purchase price. So that would be the second line item, is you've got a tenant paying down your principal. And many Canadians think of that as a way of forced savings. Somebody's putting money into my asset. Okay. The third area that we would consider the four fundamentals, I break into two components. The first would be, as an overall classification, it's going to be appreciation. So we can break appreciation down into two components, one being passive appreciation as property values go up. That would be passive appreciation, or the second form of appreciation would be active appreciation. So we have many clients that would do a renovation or maybe add a new kitchen or a new bathroom, and that would force some appreciation because they put in those new features in the home that would often bring up the value of the property. So we classify those as two categories in the appreciation. So those four fundamentals would be cash flow, principal recapture, forced appreciation, and then active appreciation.
And with regard to the appreciation part of it now, we've had, again, significant increases in the last several years, and certainly all markets in the Greater Toronto Hamilton area and beyond. What do you plan for tentatively looking forward when we've already had great returns in the last couple of years, great increases in value? Do we expect that that's going to continue at the same rate? Do we scale it down, our expectations? Do we think it's going to be flat for a period of time to be conservative? How do we try to quantify what we might expect?
I think when we think of when I'm going to talk about or advise on appreciation, historically in the Hamilton Burlington area, we've seen property values appreciate at about 11%. If I look at a 55-year average, and that's more or less in line with perhaps the TSX or arguably inflation. This is a hot topic we see and hear now. Inflation is being typically reported as a consumer price index. I think just under 6%, 5.6%. It came out last week. I'm feeling as a consumer, my cost of living has increased significantly in oil or energy, close to 50%. Groceries. So my grocery bill's up 30%. Real estate, I own my own property, but the value of my property has gone up about 30% each year. So to answer that question from a stance of where do I forecast or where do I predict, I don't know that I don't have a crystal ball. I don't think any advisor should, but I think it's going to be in line with inflation. That makes sense to me. It's a hard asset, and as we've seen, the highest levels of inflation in the last couple of years, this asset class, real estate, has fared very well to the devaluation of our currency. So I think a reasonable expectation would be in alignment with inflation. There are some additional, I guess, drivers, and when I talk about what drives real estate values, there's more or less 7 main drivers. There's things like net migration. Do we see more people coming into a region or more people moving out? Countries like Japan and Italy have experienced significantly declining or shrinking economies. And as I go 30,000 feet up here in this country, Canada continues to have a very strong immigration policy. I was just reviewing 22, 23 and 24's immigration policy, and we're looking at allowing or bringing in almost 1.3 million newcomers to this country, and something like less than 2% of them are humanitarian. So they're skilled, they're capital backed, and that is one of the big drivers in terms of value. So those 7 drivers typically are positive migration, average income, employment, the effects of transportation, and certainly within our area with the GO and making, we're becoming a bedroom community to Toronto. Certainly Burlington has, and Hamilton continues to be more accessible. So, when I look at those drivers that typically drive real estate values, coupled with one of the biggest supply or demand influence, such as population growth, I think we're in a very unique region within the country. We're landlocked by the world's largest greenbelt to the north and west of us, and Lake Ontario to the south of us. So we can't build in either of those regions today. I think we're probably in for a decade of strong price increases within this region.
Now, I'm going back to a number you shared with me just a minute or two ago. You said that the increase in real estate in the last 55 years in the Hamilton Burlington area was 11%. That's an 11% average increase over the last 55 5 years. Is that what you're saying on an annual basis?
On an annual basis, that stat might be excluding 21 or 22, the last 2 years where we've seen almost 30% appreciation. But yeah, on a like 60-year average, we've seen about an 11% annual compounded increase in value.
So if you're suggesting, for as far as prudent forecasting when looking at a property, assuming an inflationary rate of increase on the value of the property is very, historically prudent and safe to look through that lens.
Yeah, many of our clients receive a weekly subscription where we put out the best investment properties in pretty large geographical region, Brantford, Hamilton, and St. Catharines. And when we run the pro forma, when we break down those four fundamentals, the cash flow, the principal recapture, and the appreciation, we use an appreciation value of about 5%. So we try to be very conservative on forecasting, where values may go, but historically, at 11%, just appreciation. I mean, for those of us that own homes, we've seen our matrimonial homes increase significantly. I'll share with you. About 4 years ago, I moved back to Dundas, and I bought my home from a client of mine that really grinded me on price. It's like the mechanic that drives a poor vehicle. I thought the house was worth X, and he wanted X plus 50,000. And as I looked at my wife and thought, well, we're going to be here for the next 30 years. I believe I paid 50,000 more than market value on the property. Well, here 4 years later, the property value is over doubled. It's probably the best $50,000 I've spent in my life. So, I often would encourage clients, when it comes back to their matrimonial home, to not forget the basic function that real estate or housing provides, which is shelter. Is certainly part of the mindset, I think, as investors that you need to keep in mind.
Now looking forward with regard to somebody that is sort of looking at investing in real estate, but hasn't as of yet, what advice do you have for them? And one of the concerns that people have is, I don't want to be a landlord. And personally, my wife and I have owned a few rental properties, and actually one in Hamilton that we had some great challenges with regard to the tenants we had. So it can turn people off. Everybody's got stories, if it's not firsthand, it's second or third hand, about tenants. And so what's your advice to people that haven't invested in real estate, that are interested, to see the possibilities? What's your advice to people?
I think you bring up a great point. Investing in bricks and mortar, owning a rental or an income property, is not for everybody. I'm going to pause that moment. I've been very fortunate. I grew up in a, I wouldn't call it privileged. I had to get a job at the age of 12. Nothing's ever been given to me. I paid my way through school. But one of the privileges I was given was, at the age of 12, my parents' financial advisor gave me the book, The Wealthy Barber. Written by David Chilton. It's a classic. And there are two principles that I took away from that. The first was pay yourself first, 10%, and the power of compound interest. So I would call myself a lifetime investor. At the age of 12, I got my first job. I started paying myself first 10% of everything I made. That wasn't the earning capacity I have today, for sure. But I think taking action is really important. I think all of us should be investors. Those are principles that I've taught my family members, many colleagues, is to pay yourself first. When it comes back to what type of investment should we look at, I'm a specialist. I sell real estate for a living. It's how I make my income, my primary income. But I don't invest in bricks and mortar. I invest in real estate through lending, private lending, second mortgages, first mortgages. So I would call it, there are three primary ways to invest in real estate, the way I see it. The first would be, through a broker like myself, buying bricks and mortar and income property, becoming a landlord. The second would be a little bit more passive, might be something like lending on mortgages. And then the third would be, quite advanced, partnering with large developers. Like some of the largest developers in North America often raise capital through Main Street investors. So buying bricks and mortar and being a landlord is not for everybody. I made a decision just over a decade decade ago to stop competing with my clients. So I'm often asked the question, are you a broker that buys duplexes, triplexes, properties? And I've made the decision years ago not to compete with my clients for a couple of reasons. One, I grew up in this environment that is peer reviewed, that has a very high ethical standards, and unfortunately, I don't always see that same practice in our industry. So I made a decision that to answer the question, what's behind the curtain? If I were Rick to bring you a great cash flowing duplex as my client, if the roles were reversed, my first question would be, if it's such a great deal, Mike, then why aren't you buying it? So I made what I believe was an ethical decision to not compete or participate in competing against my clients. The second is, you can't compete with me. I see it first. I've got access to coming soon properties. So it was really a ethical decision that I made. I'll probably kick myself 20 or 30 years down the road when many of my clients have amassed more wealth than I have. But that's part of the reason that I believe we built a great name and a great reputation in terms of brokering real estate within the Hamilton, Burlington area.
So you're speaking of what you do for investing in real estate as more of a passive approach, and you're lending money on first and second mortgages.
Yeah.
And so how is the average person that may realize, yeah, I shouldn't be a landlord, but I am interested in passive investing, what approach can they take to get into a network where they can connect with people that could refer them, or could be people themselves that require financing for whatever reason on a first or second mortgage basis?
Yeah, I won't name names here, on the show, but there are a number of great investment networks within the greater Golden Horseshoe area. Some of them are subscription based. Some of them are just meetups. I would attribute a lot of my success in areas of life by surrounding myself with either like-minded or more intelligent people than myself. I love the saying, like, if I'm the smartest guy in the room, I'm in the wrong room. But surrounding yourself with people that have either the same passion or know-how, introducing yourself to a broker, an investment broker like myself. There are oftentimes, as we do a discovery call, meeting with a new client, that I know they're not cut out to own investment real estate or a duplex downtown Hamilton, where there are sometimes lifetime tenants. Like, they know the Tenant Landlord Act inside and out. They will eat them alive. And I'll share kind of a cute story. Many years ago, we had this great, lovely couple, British couple investors just starting to invest. And they looked at, returns. And this is a very common question that I get. Like, I want to invest where the returns are best. Why do some properties yield a 40% return and some only yield a 20% return? And I would answer that, again, boiling it down to first principles, risk. We all know the greater the returns, the greater the risk. So as I took this couple out looking for great returns, I took them through some neighborhoods that I wouldn't want to own property in. I don't think you would want to own property in Rick. The tenants are rough. They know the Landlord and Tenant Act, and if you get stuck with one of those tenants, you could be in arrears. So teaching them, setting them up for success. So over the years, these clients ended up acquiring a dozen properties. They started with very low risk, single family condominiums, that sort of thing, and today they've learned the business. I would refer her out as a property manager because she understands how to deal with that sort of tenant profile. So, like any investing, I think there's a little bit of knowledge and learning that is required. Our processes, part of them are, to determine if we're setting our clients up for success. Is it a duplex or a triplex that meets this client's risk profile? Or would they be better off investing in something passive like I do, mortgages or land development deals, where you can expect to earn, anywhere from 10% to, 20% per annum. So, many of our high net worth clients, professional clients, don't have the time to take phone calls from tenants. And that was part of the reason years ago that I got rid of my rental properties. They were fully furnished. This was before Airbnb. And I'll never forget, I had deja vu Christmas Day. I got a call from these tenants saying, like, I've plugged the toilet, can you come and fix it? And as I was about to sit down with my family for Christmas dinner, I thought, you can't pay me enough to do this. So I sold them. I got rid of those properties and kick myself often now for doing such.
So you've really spent your whole career in Hamilton, in the Hamilton Burlington area. There's been great opportunity in Hamilton, but Hamilton's gone up. The market has increased dramatically. It's increased, I think, greater than Burlington in the last number of years. But you just don't look at Hamilton anymore. There are other communities that you also pay close attention to. Can you
Yeah,
can you enlighten us as to what those other communities are and what's the attraction?
I would say that there's probably great markets across the country and across the globe to invest in. But why would I invest in Nicaragua when I can invest in my backyard and get decent returns? I'm going to speak, I think, a little bit to the industry. My license, being a licensed broker, allows me to trade anywhere in the province of Ontario. But we owe our clients fiduciary duties. And the dialogue I've been using lately, which I think is great, fiduciary duties are similar to those of an executor of an estate. They can't just be appointed the executor and liquidate the assets fast and quick and easily because he doesn't have the time or she doesn't have the time to do it. They've got fiduciary duties for that, for the estate, much like we as realtors do. I don't believe that I can provide fiduciary duties in a market that I'm not an expert in. So myself and my team service a pretty large geography from Brantford into Hamilton and around to St. Catharines and into Burlington. But I don't know anything about Oakville from the sense of advising a client. I don't know anything about North York or Windsor or Halifax. So I would boil down, if you're considering investing in bricks and mortar, single family homes, duplexes, triplexes, or the larger commercial 5, 10 unit buildings, I would align myself with an expert that understands the market in the market that you're entertaining a property. Because I can sell anywhere in the province, but I don't believe I would provide you, Rick, with fiduciary duties by representing you in Sarnia.
But you believe there's opportunities in many places across the
Yeah.
province of
I,
Ontario?
I think so. You commented on, and let me address the growth that we've seen in Hamilton here. So, about 3 years ago, the price spread, average price difference between Hamilton and Burlington was about 33%. That gap has narrowed to about 15%. I think Hamilton was undervalued for a long time. When our downtown cores are only 15 kilometers apart, I don't think there should have been a 30% price difference for a 10-minute drive. So I think Hamilton values have caught up with probably where they should lie in terms of proximity from the epicenter, Toronto. There are still great investment opportunities in Hamilton. I believe those 7 driving forces that I talked about, like infrastructure, positive net migration. The largest demographic in the city of Hamilton, is millennials, and they're all getting into buying patterns. So I think there's still great investment opportunities, but I wouldn't speculate. And I'll highlight a primary difference, I think, in speculation in real estate would be a pre-sale construction project where you're hoping that you buy today, you're hoping that prices rise over a 2 or 5 year trend. They should. Based on historical trends, they should rise, but that's a speculation versus an investment. I believe looking at the performance of how a revenue generating property performs. And if you look at those 4 fundamentals, we see properties. We had a client acquire a property this week in Hamilton, and sure, prices are up 30% from last year. This property still cash flows, to the tune of 6% cash on cash return and almost a 40% total return. So, outlier. So I would call Hamilton a primary market, great secondary markets that we participate in. And I'm sure there are many more, but these are markets that I understand. Brantford and St. Catharines, they've got very low vacancy rates, the lowest in the province, actually. And they've also got some of the highest turnover rates in the province. And if you're a novice, that might frighten you, thinking, oh my gosh, turnover on one of my units, that's frightening. What happens if I don't have a tenant? Turnover can be a good thing on rental properties. We're dictated by rent control as to how much we can legally raise the rent. So if you've got a tenant that might be in a property for a decade or more, they're certainly paying way below market rent, where turnover allows us the opportunity to bring market rents or rents up to current market value.
Real estate is a tough business. So many people go into the business and don't last. And why have you been so successful?
It's a great point, there's now 4,500 licensed realtors in Hamilton and Burlington, and the last I heard was about 64,000 licensed realtors on the Toronto board. And years ago, I heard an interesting stat. In California, there were more people that had their real estate license than their driver's license. And I wonder if we're going to see that at some point as we go through these trends. So, it's interesting. It is a very competitive industry. It can be a cutthroat industry. I would attribute my success, if we want to call it that, longevity. I've got many colleagues that have been in the business 30 or 40 years, and I admire that. I think there's a lot that we can learn from those that have experience in any industry. I think I'd attribute my success to a couple of things. Hard work. Doesn't come easy. Overnight success does not exist. So, I'm prepared to work harder than anybody else out there. I've got a great support system, both in family and in the people I've surrounded myself with. That would be number two. Surround yourself with good people that have the similar values as you do and similar work ethic. That's certainly the second key to success. And I think the third kind of goes without saying, like, treat people right, treat people the way you'd want to be treated. Whether I go to my physician or my lawyer or my accountant or any professional, they should always be putting the paycheck last and be treating the client's needs and services first.
Well, I think that's a great place to wrap up. Mike, this has been a great discussion. You've really enlightened us with regard to the importance of first fundamentals when you're looking at investing in real estate, and really you should know thyself before you get down that path. But you're obviously a great resource for many people in the Hamilton, Burlington, and broader communities, and I can see why you've been so successful. So thank you very much for being on the Mayor of Money podcast. You've enlightened me and you've enlightened my audience. So thank you very much.
It's been a pleasure. It's always nice to chat with you.
And I want to thank everybody for tuning in and watching and listening to my conversation with Mike Heddle. Mike has his own brokerage, the Heddle Group in Hamilton, under the auspices of Royal LePage. And he's an easy guy to find. Mike Heddle, Heddle. You can find him quite easily. So Mike, thanks again. Thanks again to everybody for listening. We'll see you next time on the Mayor of Money. Remember to stay positive and test negative. Thanks for tuning in.
Thank you for listening to the Mayor of Money podcast. Click the subscribe button below to be notified when new episodes become available. If you'd like to have a one-on-one discussion with Rick or have an idea for a particular guest or topic, contact him at rick@rickgoldring.com. See you next time on the Mayor of Money podcast.